Welcome. I'm Garrick Feldman. I'm a junior in my undergrad and I'm majoring in political science and minoring in Eastern European studies. Today, we're going to be looking into one of the most influential institutions in the global financial system, the International Monetary Fund, or the IMF. We're going to explore how it was created, what it does, how it handles financial crises, and its role in global governance. The IMF was established in 1944 at the Bretton Woods Conference in New Hampshire, USA. As World War II was coming to a close, leaders from 44 countries gathered to design a post-war economic system that would prevent a repeat of the Great Depression and help alleviate the strain from rebuilding Europe and the global economy after World War II. At the heart of the agreement were two new institutions: the World Bank, which was created to address development, and the International Monetary Fund, to maintain financial stability after war was over. The IMF officially came into existence in 1945 and began operations in 1947. Its original mission was to oversee the international monetary system, stabilize exchange rates, and facilitate the rebuilding of the global economy by encouraging countries to cooperate on financial and trade issues. So, as the world moved away from fixed exchange rates, the IMF shifted towards helping countries deal with balance of payment problems, currency crises, and sovereign debt issues. Today, the IMF's mission centers around promoting international monetary cooperation, facilitating balanced growth of international trade, ensuring financial stability, and providing resources to member countries in financial trouble. So today, the IMF is governed by its 191 member states. Each member contributes funds called quotas based on their economic capacity. The Board of Governors is the top decision-making body. It is comprised of delegates from each member country, typically finance ministers or central bank governors. The day-to-day decisions are made by the Executive Board, which has 24 directors representing different groups of countries. And at the top is the Managing Director, currently Kristalina Georgieva, who oversees the staff and the organization's strategic direction. Voting power is weighted based off of the amount of quotas a country pays. So this means that larger economies like the United States, China, and the European Union hold more influence due to their larger quotas. So what does the IMF actually do when a country's in economic trouble? Let's say a country's economy crashes, its currency loses value, it can't pay back its loans. This is a balance of payments crisis, and it's where the IMF steps in. The IMF acts as a sort of global financial firefighter, rushing in with emergency funds to stabilize the situation, but countries can apply for help through various lending programs, such as standby arrangements, SBAs, for short-term shocks to their economy, extended funds facilities, EFFs, for longer-term structural issues, or rapid financing instruments, RFIs, for sudden crises like natural disasters or pandemics. But here's the thing: in exchange for funding, countries must agree to economic reforms. This is called conditionality. Might include reducing government deficits, reforming public spending, or changing trade policies. The idea is to fix the underlying problem so the crisis doesn't happen again. During the Asian financial crisis of 1997, the IMF provided billions to countries like Thailand, Indonesia, and South Korea, but also required deep reforms, some of which sparked controversy for being too harsh or worsening unemployment. During the global financial crisis of 2008, the IMF dramatically increased its lending, approving new programs and making billions available to countries affected by collapsing markets and trade. The IMF also plays a preventative role, constantly monitoring economies through what's called surveillance. It conducts annual country reports, Article 4 consultations, global and regional economic outlooks, debt sustainability analyses, and it provides technical assistance to help countries improve financial management, taxation systems, and central banking. Think of it like the IMF helping countries to build a better economic infrastructure to weather future storms. Now let's take a step back and look at the bigger picture. Financial crises don't just affect one country, they ripple throughout the entire global economy. That's why the IMF plays a critical role in global governance, helping countries coordinate their responses and create shared rules and to prevent global crashes. During the 2008 financial crisis, this role became crystal clear. The global economy was on the brink, major banks were failing, unemployment was rising, and no one knew how deep the damage would be. The G20, the world's major economies, called on the IMF to lead the global response, and the IMF rapidly increased its lending, restructured some of its loan conditions, and worked closely with countries to prevent a crisis from spreading. But more than just lending money, the IMF helped design the new rules of the new global economy. It advised on bank bailouts, fiscal stimulus, debt restructuring, financial regulation, and it helped countries in Eastern Europe, Africa, and Latin America stay afloat when investors pulled out. The IMF also worked hand in hand with institutions like the UN, the World Bank, and the Financial Stability Board to ensure countries shared information and aligned policies. It wasn't perfect. Some criticized the IMF for past mistakes or being too slow to reform, but in 2008 and beyond, it provided value as a central hub for global economic stability. In recent years, the IMF stepped up again, for example, during the COVID-19 pandemic when it approved $250 billion in emergency financing and backed the largest ever allocation of special drawing rights, a type of international reserve currency to help countries recover. As the world faces new threats like climate change, digital disruption, and increasing debt in low-income countries, the IMF continues to adapt. Its position in global governance has never been more vital. So, thank you for watching.